off, we've got trade investments, intangible fixed assets, brands and goodwill, and taxation. Just to get them finished off, what are assumptions and stuff we should be looking for inside there. So we've got trade investments. The specific audit objective in relation to trade investments is as follows. So for accuracy, we need investments are properly recorded and included in the financial statements. All investments included in financial statements exist at the balance sheet date, and all investments have been included in the financial statements. Investments have been accurately valued and provision has been made for any investment whose carrying value exceeds realisable value. So their carrying value exceeds realisable value. All purchases and sales of investments have been accounted for in the correct accounting period. Oh, sorry, I don't have any spare.
I'll learn more by making notes than what I hear. I brought tax.
And then recorded investments are owned by the client on the balance sheet date, and investments have been properly classified and disclosed in the financial statements. So just on page 16 of that handout there. Okay, so that's what we're looking for trade investments. Accuracy and completeness then. Obtain a review and reconciliation of the investment control account in a nominal ledger to the list of individual investment balances. Check the arithmetical accuracy of the reconciliation. Review clearing of reconciling items subsequent to the year end and agree the individual totals to the nominal ledger. And that's usually it's always think about doing accuracy. You're always going to be doing rechecking and recalculating and stuff. And then looking at the close to your end to make sure there's nothing in the after the year end that should have been included at your cut-off point. So review the accounting policy adopted by the client for determining the carrying value of investments. Ensure the policy adopted is in accordance with relevant legislation and standard accounting practice and is consistently applied. Where investments have been acquired during the year, agree the cost to contract notes or similar supporting documentation. Ensure additions have been authorised and approved. So by right, should be doing investments, there should be maybe if you go to the minutes of the meeting, and you sit beside one of the minutes of the meeting that they actually, gave the go-ahead for those investments to be bought, and there'd be a sign-off, a signature there, probably by 2 directors signing off on them. So that's what we're talking about when you're ensuring they've been authorised and approved. Go to the minutes of the meetings maybe, and look for the approval by the directors. Agree disposal of investment to contract notes. Ensure disposal has been officially authorised and approved. So the same thing, there should be a minutes of the meeting with that approval on it as well. Check the profit and loss account and disposal of a sample investment and ensure it's been correctly posted. Okay, so that the loss in it has been, or the profit has been correctly posted. For investment held in foreign currencies, ensure the correct translation into domestic currency. Okay, and you can actually do you can print off online a currency calculator for a particular year, and it gives you the average over the year, so to make sure you've got it in the right currency at the year end. For listed investment, check the market value, the stock exchange daily list or Financial Times. For unlisted investments, the valuation may have been undertaken by the directors. In such a case, the auditor should discuss the base of valuation with the client in order to certain where the valuation has been made on the basis of reasonable criteria, and the auditor may need to acquire the advice of an expert. Okay, to make sure that the correct value is actually on that investment item. Perform an initial review to ensure completeness and obtain explanations for any material variances. Check from the list of investments that all income due has been recorded and received, and check the posting of income to the correct account in the nominal ledger. Okay, so that's all to make sure that they're accurate and complete for your first heading, accuracy and completeness. For existence and ownership then, obtain direct third-party confirmation of investments held on behalf of the client and inspect documents of title. So you could actually go to, if they have shares, you could go to, Davy stockbrokers or one of those stockbrokers and get, confirmation from them of the shares that are held. Review boards and minutes and obtain representation of managed to ascertain whether investments have been pledged as collateral or security for liabilities. Okay, and you also might get that as well on the bank form, the bank request form. The bank might have in there that they have hold over investments. They often do that, if you have life policies, they actually would have them included on your bank request form. Obtain direct third-party confirmation for borrowers in respect of loans made to them by the client. Valuation then, consider where the value of any investment should be reduced to recognise a permanent diminution, lowering in value. Okay? If an investment was written down in previous years and the reasons for the write-down no longer apply, the auditor should check that the provision has been released. Check the basis of valuations consistent with previous years. Check market value calculations for listed investment to published prices. And you said above, that's very easily done because you can actually get it up on the paper every day. Think about the shares, so the share price is given every day in the papers. Confirm the director's valuation of unlisted investments are reasonable. So that's like above on the accuracy one as well. In the case of loans, ensure repayments are made on time and interest payments are being made. Discuss with management the recoverability of the loan. Cut off then for a sample of additions and disposals during the period. Ensure they are accounted for in the correct accounting period. Disclosure then, ensure investments are properly classified as fixed or current assets. Ensure separate disclosure of investments in associates or subsidiaries. And ensure separate disclosure of income from group companies. So you actually get a lot of paperwork for all those little different pieces, all the different investments, like in associates, in subsidiaries, in shares. You know what I mean? There's a lot of evidence you can actually gather up. So that's our trade investments. Okay, our next one is on page 27. It's intangible fixed assets. Okay, so intangible fixed assets. What are we taking about intangible fixed assets?
Sorry?
Intangible fixed assets? Yeah, goodwill. And maybe research and development, could be in there as well. Like, how do you value that as it's an intangible asset? How much worth of, how do you actually value the research and development you actually have done? Think of a big pharmaceutical company who would have big investments in research and development, and how would you actually value that and show the completeness, the accuracy, all our proper ones inside in the financial statements. So the specific all objectives in relation to intangible assets are as follows. Completeness. All tangible fixed assets have been included in the financial statements of the balance sheet date. Accuracy. The cost of the intangible fixed asset based on the client's accounting policies have been accurately calculated and consistently applied. All tangible assets including the financial statements belong to the client. Addition and disposal of intangible assets have been recorded in the correct accounting period, and intangible assets have been correctly classified and disclosed in the financial statements. So for completeness, audit assurances in relation to incompleteness can be best achieved through a sound knowledge of the client's business. For example, if the client is in possession of a license or patent, the auditor should ensure that such items are capitalised. And obviously you'd have to have a copy of the paperwork in your file as well for whatever license or patent they may have. Discuss and obtain representations from the client solicitors. In the case of R&D, review the expense account to determine where development cost should have been capitalised instead of written off. For accuracy then, review the client's accounting policies and ensure costs are accurately calculated and consistently applied. Okay, that's actually, that's actually on everyone. Review the client's accounting policies and ensure costs are correctly calculated and consistently applied. Ensure estimates useful economic life are reasonable. Check the policy for the calculation of amortisation and ensure it's consistently applied. For additions, read details of the acquisition to support the documentation and check for arithmetical accuracy. And check that the additions has been properly authorised. So how do you do that? You go to your minutes meeting maybe as well from the directors. In relation to disposals, check that the assets have been deleted from the asset register and from the nominal register. Check the profit and loss account has been calculated correctly and accounted for properly. Check the disposal was properly authorised and agree write-offs to authorisation and consider whether the charge should be treated as exceptional.
How would you have a disposal of intangible fixed assets?
maybe if you were selling part of the business and you sold the goodwill with it or something.
Oh,
Yeah, or if you sold a patent over an item. Yeah. Ownership, in the case of patents, the auditor may obtain third-party confirmation from the Patent Office. Evidence of ownership may be seen from the receipt of income, which would be royalties. Cut off for a sample of additional disposal, ensure that they were accounted for in the correct accounting period. Valuation, check the client's accounting policies in relation to capitalisation and ensure they are in accordance with the standard accounting policies, IAS 38, intangible assets, and generally accepted accounting principles. And you have that from your accounting, yeah? Review items brought forward for the previous year and ensure the conditions for capitalisation still apply. Ensure that assets which have suffered a diminution or whatever in value are properly written down. How would you pronounce this? Diminution. I don't know. Disclosure then. Ensure separate disclosure of R&D projects which give rise to a deferred expenditure, and ensure the client fully discloses the nature of all intangible assets included in the balance sheet and the base upon which they have been valued. Then, additional specific audit tests in relation to brands and goodwill are as follows. So for brands, the auditor may consider the need to use the service of an expert in determining the accounting treatment and valuation of such intangible assets. I'll be going through in another pack about how you use the service of an expert in an audit. The audit should start in the base of measurement, ensure that it is correctly calculated and consistently applied. You can use that across the board. Ensure the amortisation policy is reasonable, and the auditor should consider the marketability of the asset. It may be that in the future economic benefits might not materialise due to, say, a failure by the client to maintain the value of the asset by not engaging in advertising. For goodwill then, ensure the asset to which fair values have been attributed after acquisition are in accordance with standard accounting practice. Agree the purchase price of the acquisition to supporting documentation. Ensure the fair values are completely apportioned and justified, in particular where values are attributed to separate net assets. Audit evidence might include valuers' reports or clients' calculations. Confirm that a business on which purchased goodwill arose has not been sold or closed down, and check the amortisation policy is reasonable and correctly calculated. So if you ever get goodwill, just make sure to always mention about the amortisation. That's the biggest part of goodwill in the accounts, the amortisation of it.
How would you amortise it over how long?
There's a certain, I wouldn't be doing much goodwill now in day to day, but there's a certain IAS that covers what amortisation you should actually have, where you release it into the profit and loss account by such a percentage every year. Yeah, I'm not sure now what exactly how much would be, but you're supposed to release so much of it every year. It's like all it is amortization. It's like a provision.
Grant, 40% grant.
Yeah, and you're just releasing part of it all the time.
Yeah, I think actually John might have mentioned it first.
In accounting. Yeah.
Yeah.
Okay, and all we're left with now is taxation. Okay, so in taxation you've got 3 different taxes to look at. You're looking at corporation tax. Well, you could say 4 corporation tax. VAT, you'll probably have PAYE, PRSI, which we've looked through our wages cycle, and then there's deferred tax as well. Okay, so essential objectives in relation to tax are as follows. A review of the client's tax position should be conducted prior to the audit in order to identify any potential controversial issues. Okay, the tax figures and financial statements are derived from reliable accounting records. The tax amount reported in the financial statements agree with the underlying accounting records. Like, you know, when you do a company account, your taxation is on the bottom. So you have your profit from operating activities, and you have your expenses, and you have your profit, and you have your tax, and then you have your profit after taxation. So it's actually shown there, you know, in the face of your company account. You've done company accounts, haven't you? Did you do them last year or is it this year you're doing them?
We're doing them this year.
You're doing them this year. You didn't do company accounts last year, no? In second year?
Possibly.
Possibly.
Last year?
There's more this year, is there? Yeah.
Subsidiary companies and stuff.
Oh, yeah. Yeah, subsidiaries, yeah. just to bring in more into
The
it.
first two was sole traders and stuff, the second two was
Yeah.
companies.
Was companies and cash flow statements and stuff like that, yeah. The corporation tax charge and provision has been properly calculated and accounted for. Income tax has been properly calculated and accounting for. Deferred tax has been correctly computed and recorded. And tax charge and provisions have been properly classified and disclosed in the financial statements. So for corporation tax, obtain and prepare a corporation tax computation, making adjustments for disallowable expenditure. Check tax computation has been properly prepared. Check that all relevant income has been correctly classified according to schedule and case. Check the capital allowances have been claimed only on eligible assets. Ensure the charge and income are treated correctly. Do your charges, your trade charges and your non-trade charges. Check all chargeable gains have been included and properly calculated. Ensure that all claims for relief are valid and that losses forward have been utilised. Check the arithmetical accuracy of the computation. Check that the appropriate tax rates have been used. Obtain a tax reconciliation from client which analyses any differences between the normal tax charge for the year and the actual charge. Check the accuracy of any previous under or over provisions written back and agree the tax figure per the nominal ledger to the supporting tax schedules. Then for our VAT, check that there's a VAT registration and note the VAT registration number. Okay, that's something you might not think of, just to check that they actually have their VAT registration number. It reconciles the turnover per the financial statement with a turnover per the VAT account. Check the postings to the nominal ledger. Check the VAT returns for the period have been properly compiled. Check that all VAT returns have been submitted by the due date to avoid interest penalties, and where returns are overdue, consider the need to accrue for interest due. Agree amounts paid and received, check payments in cash books. Ensure VAT payables included in creditors and VAT receivables included in debtors. To the client's procedures for identifying and analysing disallowable VAT. To that all VAT invoices are issued for all standard rate supplies and the invoice comply with VAT regulations. Another one is to ensure that the company name is actually properly on the invoice, the proper company name. And especially if someone just from a smaller point of view, as a sole trader and converted into a company, then they sometimes forget to change the name. They might have John Smith, he was trading at John Smith, and now he's John Smith Plumbing Limited. Yeah. And the invoice will still say John Smith, not John Smith Plumbing Limited. Agree the VAT balance in the nominal ledger to the VAT summary and to the financial statements. Like you'll always have a little VAT T account that you'll be able to check all these figures from. And you have a little tax T account and you have a wages T account as well, all done out. Deferred tax then, get the deferred tax computations and ensure the client has correctly calculated the full deferred tax provision using the liability method. Review the evidence to determine whether the deferred tax liability will or will not crystallise. To the any losses which are offset against potential deferred tax liabilities are actually eligible for offset and check the amounts of these losses is correct. Examine the client's forecast of capital expenditure and expected future capital allowances for at least 3 years. Check the preferred tax provision has been calculated based on timing differences or to think that they will reverse without replacement. Ensure appropriate disclosure matters required disclosure are the date on which tax is payable and exceptional items with a tax effect. Okay? So all this pack here is, when you're doing the exam questions, we have that alongside you, okay, because you have all the creditors, all the debtors, all the wages, all the sales cycle, the purchase cycle, all your cycles are inside in this. So if you're stuck on the question, go in here and has a crop move and give you an idea of what I should be looking for if they're asking you the audit procedures ones. Okay, and it's actually good, that everything is done separately inside there. Okay, so I want to move to the next pack now. I want to go through a few bits and pieces inside that just to get us started. It's the next one, and I think section 1, the next, after the coloured page, is it section 1 is the next one?
Audit practice, section 1.
Yeah. Yeah. Yeah, the ISAs. I just want to get covered with all the ISAs. Like I know we've some of them done, but I just want to get, go through bits and pieces. So just page 2 there. Okay, it's just about our engagement letters. I know I've given you notes already about engagement letters, but this is just done in like little summary form, and the example of the engagement letter is inside here, even though I've given you, example of an engagement letter already. So if you look at number 2, and what I want to there's a couple of things there on page 2 I want you to highlight. So an auditor will issue an engagement IS 210 letter to signify his acceptance of the appointment. It forms a contract between the auditor and the client. It should clearly define the scope of the audit and the extent of the auditor's responsibilities. Each engagement letter should be individual to the client, however, it's likely to contain the following sections. Okay, so there's just where the bullet points are. So I want to highlight the first part of it. So confirmation of the appointment would be your first one. Then 2 separate ones here: the responsibilities of directors and the auditor. So you're looking at what the directors are responsible for and what the auditor is responsible for under the Companies Act. Okay, so that's your second bullet point. Okay, the third bullet point is the scope of the audit. So I've just highlighted the scope of the audit there. And what I mean by scope of the audit will ascertain the accounting systems and evaluate the controls. The nature and extent of tests he then carries out will vary according to the assessment, and any significant weaknesses found will be reported to management. The fourth one, the management representation. So I'll just highlight management representations. It's like that if he's not sure of stuff in the audit, he actually will go back and see what the management may have to say about it. So where appropriate, the auditor should confirm that prior to completion of the audit, he might seek confirmation of certain matters affecting the financial statements. Okay, the next one, other information with published accounts. Okay, so just highlight other information with published accounts. The auditor will request to see any other information that is to be issued with the financial statements prior to publication. And think now of Kerry Agri, if you go into the company's registration office, you can see their accounts inside there. Or any company, as long as you know their name, you go into the CRO, you can actually see all their financial statements. So if they're putting something else in, with the accounts, just to make sure that, that they're okay with the auditor. Our next one, irregularities and fraud. So if you highlight irregularities and fraud. Okay, the responsible protection and prevention of fraud lies with management. Fraud detection is not the main purpose of the audit, but the auditor will plan his work so he has a reasonable expectation of detecting material misstatements in financial statements, whether caused by error or irregularity. However, the audit should not be relied upon to disclose irregularities and fraud. Okay, so that's your fraud. Then the next heading you want to highlight is post-balance sheet events. And the audit responsibility ends when he signs his audit report. However, he will request management to inform of any relevant post-balance sheet events occurring between the date of the audit report and the AGM. Okay, we'll be going through the audit report hopefully the next night, and that's an important part of it. The next one, other services. Okay, other services, reference will be made to any other services the audit is providing in addition to the statutory audit. Is likely a separate engagement that will be issued in respect of these services. So like if you're doing a small company, you would have done the accounts and you'd be auditing them as well, so you'd actually put that in there. But then, if you're usually for bigger companies, you're trying to keep them separate, that you'll have one department that might prepare the account and you have a total separate auditing department that does the audit.
It's like you're declaring
that this is what, yeah, that's exactly what you're doing for the client. Whoever auditors, we are preparing the audit as per the account prepared by the client. Do you mean that's specifically saying we're using their financial reports to prepare the audit, and we had no part in actually preparing the financial reports. Fees. The general base on which these are computed, rendered and paid should be set out. Okay, so fees will be our next heading. The law governing the terms of the contract. And then the complaints procedure. Should a company be dissatisfied with the service provided? And the reason I just wanted to highlight all those headings is that you'd see them straight away. And there's an exam question you see where they ask you to list what may be on the engagement letter. So if you had, all they were looking for was the headings. Just so if you had the headings, do you mean that was that part of the question answered? Okay, I'm not going to go through all of this because we did all the engagement letter there before. The next one, if we go to page 8, okay, it's quality control. Okay, so the firm should establish a system of quality control designed to provide a reasonable assurance that the firm and its personnel comply with professional standards and regulatory and legal requirements. So if you, for quality control, what we're looking at is complying with professional standards and regulatory and legal requirements. So that's the important part of your quality control. And the report issued by the firm or engagement partners are appropriate to the circumstances. So elements of a system of quality control. The firm's system of quality control should include policies and procedures addressing each of the following elements. So we've got leadership, responsibilities for quality within the firm, ethical requirements, acceptance and continuance of client relationship and specific engagement, human resources, engagement performances, monitoring. So like that could be a question that they'll ask you for the elements of a system of quality control, and if you have those headings, that's what you need, to actually start on your question. Like in this part of it, it's like what they're doing is they're asking you in the auditing section as opposed to auditing practicing, they'll be asking you what system, what should be in there, whereas next year they'll be actually going into a lot more detail about it. So leadership responsibilities for quality within the firm. So the firm should establish policies and procedures designed to promote an internal culture based on the recognition that quality is essential in performing engagements. Okay, so that quality is essential in performing engagements is your important part. Such policies and procedures should require the firm's managing board of partners to assume ultimate responsibility for the firm's system of quality control. Okay, I'm not going to go through all of it now, just want to highlight the important parts of it. Ethical requirements. Okay, the IFA code established that fundamental principles of professional ethics will include integrity, objectivity, professional competence and due care, confidentiality and professional behaviour. So that's normal for what we actually have all the time for our ethics. Okay, independence, and independence is very important. So I'm going to mark independence as being one of the very important ones for when we're doing our audit. Okay, so the firm should establish policies and procedures designed to provide with reasonable assurance that independence requirements are met. So policies and procedures include communications of independence requirements, identify, evaluate circumstances and relations that create threats, take appropriate action to eliminate or reduce by applying safeguards or withdraw, engage with partners to provide the firm with relevant information with client engagements including the scope of services, to enable the firm to evaluate the overall impact, if any, on independence requirements. Personnel to promptly notify the firm of circumstances in relation that create a threat to independence so that appropriate action can be taken, and the accumulation and communication of relevant information to appropriate personnel so that the firm and its personnel can readily determine whether they satisfy independence requirements. The firm can maintain updated records relating to independence. The firm can take appropriate action regarding identified threats of independence. Okay, about independence, I mean that you must be totally independent of the director. There must be no relationships inside there. Like you can't be like someone who goes golfing with the director of the company every Saturday for 52 weeks of the year. And that's not going to show that you're actually independent. Anyway, the question there as well, were they offered GA tickets or match tickets for them for doing service? That's all going to affect the independence. Okay, the policies and the procedures should include requirements for notify the firm of independent breaches, promptly communicate identified breaches, set out criteria for determining the need for safeguards to reduce the familiarity threat to an acceptable level when using the same senior personnel and an assurance engagement over a long period of time. For all audits of financial statements of listed entities, require the rotation of the engagement partner or after a specified period in compliance with the IFAC code and national ethical requirements that are more restrictive. Okay, then acceptance and continuation of the client relationship and special engagement. So that's like, just like if you have a continuing engagement, okay, which we would have gone through about continuing engagements already. Human resources, which is on the next one. Okay, and we all know what human resources are, so I'm not going to read down through all of that. Okay, but just to highlight about the human resources. Then number 4, engagement performance. Okay, and the matters addressed include the following: how engagement teams are briefed on the engagement to obtain understanding of the objective of their work, process for complying with applicable engagement standards, and the process of engagement supervisors, staff training and coaching. So like you think about, like, do you know what I mean, if you had to go out and audit Kerry, what senior person have you got, what intermediate partners you have here, and then what junior staff you have, and who's going to be with those junior staff to make sure the work is being done properly. Because a lot of the junior staff will be doing a lot of the ticking and bashing out of stuff to get it. But like, you have to have someone obviously over them then to make sure it's being done okay. Method of reviewing the work performed, the significant judgments made and the form of reporting being issued, appropriate documentation of the work performed and of timely and extent of the review, and process to keep all policies and procedures current. Then supervision includes tracking the progress of the engagement, considering the capabilities and competence of individual members, addressing significant issues arising during the engagement, identifying matters for consultation or consideration by more experienced engagement team members during the engagement. Like, do you know what I mean? You're not going to have someone just into auditing working by himself. Okay, you're going to have someone showing him the ropes, and that's just like, that's what we're talking about quality control here. Okay, making sure that all that is documented and kept track of. Number 5 then, consultation. The firm should establish policies and procedures. Okay, appropriate consultation takes place in difficult or contentious matters. Sufficient resources available to enable appropriate consultation to take place, and the nature and scope of such consultation are documented, and conclusions resulting from consultation documented and implemented. It's no point having these meetings, but all these difficult matters are there if you don't actually document it, because you've no audit evidence saying that this has been done inside the audit. Okay, then we're over to monitoring. The firm should establish procedures again. Information community should include the following: a description of the monitoring procedures performs, the conclusion drawn from the monitoring procedures, and where relevant, a description of systematic, repetitive and other significant deficiencies and of the action taken to resolve or amend those deficiencies. Because like, if you have someone doing the same audit year after year after year, all they're doing is just ticking off maybe a box, and maybe they're not doing their proper auditing job because they got over familiar with that particular audit client. Okay, that's our quality control. So that's all part of internally inside the audit practice itself for our quality control. Okay, then our next one, ISA 230 documentation. I actually went through that the last night. I want to look at fraud and error. I just want to mark fraud and error as important because there's a lot of exam questions where fraud and error is coming up inside in it, and that is on page 18 for fraud and error. Okay, and you remember the documentation one from last week, or last week before, the permanent audit file, the current audit file, the working papers, all that kind of stuff? Yeah? So I'm going to go over to page 18. I didn't do fraud and error the last night, I didn't? No. Just want to mark this one now as one of the important ones, especially for the fraud part of it. so ISA 240, the auditor's responsibility to consider fraud in an audit of financial statements, set out standards and guidance for auditors on the subject. So definitions: error. Error is an unintentional mistake in the financial statements, okay? So your error is an unintentional mistake in the financial statements, mathematical mistakes, oversight or misinterpretation of facts, unintentional misapplication of accounting policies. Irregularity then, something contrary to a particular rule or standard. So if a PC were to limit individual vouchers to €50, with single vouchers being processed for greater than €50, the entry within would be an irregularity. Then misstatement, something stated wrongly. So where the balance sheet shows a building that costs 1 million, when the actual building costs 1.3, can arise due to fraud, other irregularity or error. So fraud, it comprises both of deception to obtain an unjust or illegal financial advantage and intentional misrepresentations affecting the financial statements by one or more individuals among management. Okay, and we need to no further than, what was it called? What is it? No, in Ireland, Anglo, where they were like having the bank, the loans actually disappearing off the balance sheet and then actually reappearing post year end again. That's your typical example of, do you know what I mean? It's not like a little error. I mean, we're talking about millions of euro worth of money there. Okay, but employee of third parties is for the court to decide in a particular instance whether fraud has occurred. So deliberate falsification of documents and records, deliberately ignoring our errors requiring correction, and deliberate suppression of information. So responsibilities for fraud and error. So the important thing, it's not the auditor's responsibility to discover fraud, it's the director's. So it's direct responsibility to take steps to prevent and detect fraud and error. It is not the auditor's function to prevent fraud and error. The fact that an audit is carried out may, however, act as a deterrent. The auditor is concerned with both fraud and error, since either can cause a material misstatement in the financial statements on which the auditor is giving an opinion. And planning and performing the audit to reduce audit risk to an acceptably low level, the auditor should consider the risks of material misstatements in financial statements due to fraud. So factors that may increase the fraud and error: management domination by one person or a small group of people, unnecessary complex structure, high turnover rate of key accounting personnel who do not take leave or holidays. Jeez. Okay, because they could actually be trying to hide something, and if somebody else comes in, I mean, they might find it straight away. Understaffed accounting department, volatile business environment, inadequate working capital, deteriorating quality of earnings, and inadequate segregation of duties. So that could come up as a question. Factors which may increase the risk of fraud or error. So I'd actually highlight that one, because it could be, do you know what I mean, a very easy question to put in. And we'll see as we're going through, there's a good few questions on fraud and error in the pack. On top of the next one, lack of monitoring of control systems, unusual transactions, cash direct numbered bank accounts, payments for services disproportionate to effort, significant transactions with related parties, and inadequate IT systems. So they're all things that could lead to an increase of risk and of fraud and error. So based on the risk assessment, the auditor should design audit procedures so they have a reasonable expectation of detecting misstatement. And that's you see that a lot in the exam questions, they actually get that as an answer. So based on the risk assessment, the auditor should design audit procedures so they have a reasonable expectation of determining misstatements arising from fraud or error, which are material to financial statements. So if I just want to highlight that part there, that's good, if you can remember that in a question. Okay, a reasonable expectation of detecting misstatements. Okay, the auditor's job then is to gather evidence where the financial statements give a true and fair view. The auditor therefore aims to identify all material fraud and error, since they will be directly affect the view given by the financial statements. Investigation of possible misstatements. When auditors become aware of information which indicates that fraud or error may exist, they shall obtain an understanding of the nature of the event and the circumstance in which it has occurred, and sufficient other information to even the possible effect on the financial statements. The event eventuate the possible effects on the financial statements. So I told you I'm better with numbers than words. If the auditors believe that the indicated fraud or error could have a material effect on financial statements, they should perform appropriate modified or additional procedures. Okay, and we'll be going through that the next night about issuing the audit report and if we've to issue a modified opinion. In assessing the potential materiality of fraud and error, the auditor should consider the potential financial consequences, whether the potential financial consequence require disclosure, whether breach of law may be involved, whether the potential financial consequence is so serious as to call into question the view given by the financial statements. So review reporting of fraud or error. The action taken by the auditor to report an event varies in relation to its nature and the gravity of its consequences. Reporting to management. If the auditor suspects fraud or discovers a material error, he should, as soon as possible, report his findings to management, the directors, or the audit committee. Reporting to shareholders. If the auditor believes that the published financial statements are materially affected by a fraud or error, he should add an explanatory paragraph to his report or qualify his report depending upon the circumstances. And then reporting to a third party where the auditor believes the suspected fraud should be reported to an appropriate authority in the public interest. He should notify directors in writing of review, and if it does not voluntarily do itself, should report to himself. And directs the director of what's his name? Yeah, it used to be Paul Appleby. I'm not sure what the little guy's name is, but it used to be Paul Appleby. Used to be the guy as reporter, but I know he's after retiring. And then where the suspected fraud casts doubt on the integrity of the directors, the auditor should make a report direct to the proper authority in the public interest without delay and without informing the directors in advance. And if you go on to that ODCE website, they actually have them listed down what fraud, what errors in fraud, fraud was actually reported, and there's actually not that many cases. There's more and more coming as time goes on, but there aren't that many. But if you want to go on, the ODCE is where you actually find.
They're only the big companies reporting.
We're saying everyone, do you know what I mean?
I know,
Technically, no, that's it, yeah. And by the good to know with most small companies are audit exempt, you know, so there isn't as much.
They change the rules on that now, there's a lot less of them will have to.
Yeah, the 8.3 million, now like your turnover has to be like before you can become that you be audited. And there's actually more coming in, even the charities are coming in now as well. Once their turnover is less than 100,000, they're going to be audit exempt as well, which is great. But that hasn't come in yet now, it's on the way. I think June 2015 is going to be another big date for more Companies Act changes. Yeah, June 2015, yeah, exactly. They're getting ready for that now. So that'll bring a lot of joy, it takes the pressure off as well. You know, if you are doing audit exempt, all you have to remember is make sure to get your accounts into the Companies Administration Office in time. You've got an ARD date with a company, it's usually 9 months, it should be 9 months after you're in, but it might be less than that. And you have 28 days to get them in from the ARD date. And if you don't get them in within that time, you actually lose your audit exempt for 2 years. And you have to go back and reapply for the audit exempt. So once you get the audit exempt, just make sure you actually hold on to it. Okay, so that's fraud and error. We've done, if you go back to the front page there now again, we've done ISA 300 planning, we've done ISA 315 obtaining understanding, we have done ISA 330 the audit procedure in response to assessed risk, we've done materiality. Okay, I'm going to do the next one there now, ISA 260 reports directors of management. We've Just before we go on to that one, I want you to look just at materiality. I know you're probably sick of looking at materiality, but if we go to page 39 there a minute, it's actually a question on materiality.
Where is that?
Page 39. Okay, 38 gives you I'll give you those rules already, the 1 to 2% of turnover, 5 to 10% of profit before tax, 5 to 10% of net asset. So you have a little chart on that inside in your notes. If you go over to page 39, there's a little question there, materiality, a worked example of it. So you're the auditor of Temple & Sons Limited, a medium-sized company which operates in the food industry. You are required to decide on the materiality of the following items. So the company's annual turnover is 1.7 million in the year under audit. The audit revealed errors in the total for fixed asset cost of €2,600. So out of our turnover 1 million, do you think 2,600 is going to be
No.
material? No. So if you take, what is it, 2,600 divided by 1.7, percent. How about not even a 2%, not by 2% materiality. And if you look at part A, the answer below, the year of 2,600 is small in comparison with the overall view represented by the accounts. It is 0.2% of annual turnover, therefore this item is not considered material. The balance of debt at the year end includes a figure for 250,000 for a loan to a senior employee. The loan was authorised by the board of directors. So, is that material? It's going to be material. No matter, usually, if there is a loan to employees or loan to directors, no matter how much the amount is, you'll always look at them as being material. So the figure of 250,000 for an employee loan is such a magnitude it should not be included under debtors. This is a material item and affects a true and fair view of the financial statements. So it actually should have probably a separate heading for that, loan to director. You decided the figures for depreciation on motor vehicles understated by 5,000. The cost of motor vehicles shown in the balance sheet is 102,600. Okay, so we think that's going to be material. How much is it? Divided by 102,600. It's 4.87%, so it's nearly 5%. So it could be something that could affect the accounts, couldn't it? So all you understand the 5,000 is a significant figure in relation to fixed asset cost of 102,600. The auditor may consider the item to be material. This may not consider the item to be material. This is because depreciation itself is an estimate and is subject to a great deal of approximation. Okay? Because it's actually a provision in itself. Then director's remuneration rate is 8,700 has not been disclosed in the financial statements. And to make a difference how much director's remuneration is, it's always going to be material because it has to be reported in the financial statements. When you're going through the notes and the accounts, there's always a place where you put in about director's remuneration or pensions paid to directors. So that's always a material item. So the director's remuneration is always considered to be 100% material, and therefore the auditor would treat the omission as material even though the figure of 8,700 is small. Okay, so they'd actually have to go back and change their financial statements. Or if they couldn't change the financial statements, he'd actually have to put in a note that the account gives a true and fair view except for this statement in it. Okay, just like to get Joe, from a practical point of view, materiality, Joe, it's actually just a nice little question there to see, is it material or is it not material? That's it, yeah, coming from an exam. But that's part of the audit practice one, you know, so. But a lot of the audit practice questions are, you know, obviously going to be harder. There's actually good examples of stuff in them that I'm going to pick out some that we could actually use in class as well, just to, they bring, make things more clearer, yeah, and more practical examples, you know, to get the understanding behind them. Okay, so that's materiality. I want to go on now to page 40, which is ISA 260, report to the directors or management. Okay, this one is only short, so like one pager. So ISA 260, communications of audit matters with those charged with governance, recommends auditors consider matters which have come to their attention during the audit and whether they should be included in a report to those charged with governance. The principal purpose of reports to directors and management are for auditors to communicate points that have come to their attention during the audit, on the design and operation of the accounting and internal control systems, and to make suggestions for their improvement. Another constructive advice, for example, comment on potential economies or improvements in efficiencies. Another matter, for example, comments on unadjusted errors in the financial statements or in particular accounting policies and practices. So your timing then, to be effective, the report should be made as soon as possible after completion of the audit procedures, giving rise to comments, because you want them actually fixed for the next year ahead. Do you know what I mean? As soon as you've got the accounts done, or the audit done, you should be looking at getting this letter out and making sure that these changes should be made, so within the audit next year, these mistakes are not coming up again. Normally, audits will ask for a reply to the points which have been raised in the report, indicating the actions which management intend to take. This is important as it allows the audit to follow up on problems areas identified, hoping preventing them from having an ongoing impact in future years. The addressee, normally the report will be addressed to those charged with governance, and we have to do corporate governance. You probably have touched on corporate governance before through another theory topic, but we'll be going back over corporate governance again. And normally the addressee would be to the directors, okay, shareholders, normally directors, because the directors are actually running the business. Disclaimers, auditors explain that the report is not a comprehensive statement of all weaknesses which exist or all improvements which may be made. That documents only those matters which have come to their attention as a result of audit procedures performed. Auditors normally state that the report is being prepared for the sole use of the client entity. It must not be disclosed to a third party or courts are referred to without the written consent of the auditors, and no responsibility is assumed by the auditors to any other persons. So an effective management letter should have the following qualities: clear and constructive, factually accurate, relevant, structured, specific and timely. And it's actually just, I've come across some exam questions as well on this, okay, and they look for the effective management letter should have the following qualities. So, do you know what I mean? Just that little paragraph down there. And the importance of timing them, okay, that they're done as soon as after the audit has been completed. That's a nice short one, the ISA 260. The next one, on the next page is going over the audit. You'll see but you've got that in your notes, so the plan where I gave you out all the little bits and pieces we're looking at. So that's systems-based auditing. So there's a good lot. We're going to be bypassing on that. Jump to the ICQs and the ICEQs, which we've gone through already. Okay, all the wages cycles and all that. Yeah, you remember that? Yeah? Yeah. Okay, so I'm up to page 44. Then I'm going to have to do a quiz night where I'm going to put quizzes. They actually have that now. They actually find it very good for the law and the business management in first year. And he brings in quiz nights and he gets them to do the questions. And I think it helps them a lot to get so I might do that yet. But I mean, just to get John used to thinking about the auditing stuff. Okay, so we've got audit evidence, ISA 500. So, expected from audits for periods on or after 15th December 2004, audit evidence take the auditor to obtain sufficient appropriate audit evidence to be able to draw reasonable conclusions on which to base the audit opinion. Factors the auditor takes into account, okay, these knowledge of the business and the industry, the persuasiveness of the evidence, and the degree of risk of misstatements. Factors affecting risk of misstatement, the nature and materiality of the items in financial statements, the audit experience as to the reliability of the management and staff of the enterprise and its records, the financial position of the enterprise, and possible bias. Sufficient means that a necessary quantity of evidence must be obtained, and appropriate means the evidence must be quality. Okay? And we've done that, so I gave you the little thing, the quantity and the quality for audit evidence. There's a little diagram actually done out of it. Okay, so sufficiency of evidence. Auditing to provide reasonable but not absolute assurance that the financial statements are free from material misstatement. Informing the audit opinion, therefore, auditors do not normally examine all the information available. Appropriate conclusions can be reached about the financial statement assertion using a variety of means of obtaining evidence, including sampling. Okay, I'm going to do sampling next time, and I'm going to do sampling tonight. The audit judgment as to what is sufficient to prove the audit evidence is influenced by a number of factors such as assessment of nature and degree of risk misstatement at both FS level, that's financial statement level, and account balances or classic transaction level, nature of accounting and the IC systems, the internal control systems, including control environment, materiality of items being examined, auditor's knowledge of the business, findings from audit procedures and from any audit work carried out in the course of preparing the financial statements, and source and reliability of information available. Okay, and what goes on to this then is our crop move, the relevance, okay, which we've gone through already. We've gone through our assertions for each of them. Okay, and see on the bottom of page 46, it's got the AEIOU, the analytical, the inquiry, the inspection, the observation, the communication, which you already have done little notes on that already, about all that. Okay, and then if you go to page 47, this direct versus indirect evidence, the results of both test and controls and substantive tests will supply the audit evidence that the auditor needs in order to form his opinion. It's actually emphasised the difference between the two types. So we have satisfactory compliance tests indicate that there are controls in operation which ensure the transactions should be processed correctly, and this is indirect evidence. Substantive tests are tests which ensure transactions have been processed correctly, and this is direct audit evidence. Just in case they ever ask you what is direct versus indirect, and you're going, gee, Matt, what are they on about here? Okay, indirect is that your compliance tests and your control environment, whereas direct audit evidence is your substantive testing. It's all the testing the auditor would have done himself. Okay, so direct versus indirect. It's just another way of putting internal controls versus substantive testing. But just in case they asked it, you know, direct versus indirect. So you actually have a lot of notes already that I gave you on audit evidence. And think of your audit evidence, okay, quality, and think of quantity and quality, your crop move, and how you actually get it using your AEIOU. Okay, that's what you could actually think of for audit evidence. Okay, then analytical procedures. And analytical procedures, we're talking about ratios and that kind of stuff for our analytical procedures. Okay, so ISA 520 analytical procedures. Analytical procedures can be considered a more global approach to substantive testing. Okay, so the AEIOU, do you know what your substantive test? The A stands for analytical procedures. So instead of selecting a sample of transactions or balances that make up the overall figures in the accounts, the overall figures itself can be analysed for accuracy using various techniques. Analytical procedures involve the analysis of relations between balances with the accounts, balances in the accounts with other internal data, and balances in the accounts with other external data. Specific examples could include monitoring the trend in key ratios over time, comparing key ratios with similar companies or with industry averages, comparing balances with other information. It's important to realize that proper performance of analytical procedures is vital for one of the most difficult areas to audit. A simple list of the movement in ratios is generally not sufficient. The approach to analytical procedures is identifying relations between data, ensuring they are fully understood, Develop expectation of balance in the accounts. Compare expectation to actual balance. Seek explanations for material differences. And key ratios can be considered your gross profit margin, net profit, debtor days, stock days, creditor days again, current ratio, quick ratio, return on capital employed, gearing, and interest cover. So, like, if you were doing, if you're asking you about all the procedures for debtors, you'd always mention about doing your analytical procedures and doing debtors days ratios. The list could be adapted to identify those areas that are important to the client. Ideally, a 5 or 10 year summary of rates should be kept so that trends can be more easily identified. We have 4 years on our account. We have the comparison for 3 years, and then we have the current year doing as well to make sure that they're staying fairly similar. That fact will affect, and that's just not for companies being audited for.
Is that because if you go back further, it could be relevant because things are different?
Things are different, yeah, especially like, with the last couple of years where things have been, do you know what I mean? They could be increasing now again.
It's not a reasonable comparison.
No, do you know what I mean? Yeah. So factors that will affect use of an computer are the strength of relationships, reliability of data being used in the analysis, depth of knowledge the auditor has of clients, nature of the company. Okay, so that could be another question they could put in there. Factors that affect the use of analytical procedures. Okay, the strength of the relationships, the reliability of the data being used in analysis, the depth of knowledge the auditor has of the client, and the nature of the company. So the depth of knowledge makes analytical procedures difficult for new clients, and then nature of the company, a company of many similar divisions, i.e. a chain of shops, provides great scope for comparison of data. Comparison data is one of the general types of internal control procedures. In other words, many companies will be doing their own regular analytical procedures themselves. It may be possible for the external auditor to rely on the analysis carried out by the company, but it will depend on the reliability of those who did the work. For example, we could get evidence as to the accuracy of the current year payroll expense in the income statement by comparing figures with last year's, noting starters and levers, any pay rises, tax changes during the year. Okay, and payroll might be better because you could have a lot of people, starting and leaving. You could have a lot of people on different, PRSI rates, and it's very hard to analyse payroll like that. Comparing payroll with other related figures in the financial statements, this depends on the specific company, but could include turnover, profit, staff and entertainment expenses. Okay, the ratio part is actually more accurate than actually looking at some of the figures of that. But we always have 3 years accounts up to compare, figures across the 3 years with the year you're doing at the moment. Especially like, for farmers and stuff, they can be very up and down because they can have a very good year, very bad year, depending on the weather and everything. You see big spikes up in if they have to buy extra feed or if they have to. And at the moment, if you've got a haulage contractor and you were comparing their figures across, the price of diesel has gone way down, so the costs for their lorry expense will be way down compared to last year with the cost of diesel going down. So it's hard to use comparison sometimes like that. Okay, so that's analytical procedures. Okay, I'm skipping all the time because there's a good lot in that. I'll be coming back to it the next night. I want to just look at the orders of accounting estimates, which is on page 56. Okay, and it's hard to audit, estimates because they are an estimate. Okay, so estimates are approximations necessary because there is no precise means of measurement. Examples include inventory provisions, bad debt provision, depreciation and amortization, provision for warranty costs, provisions for costs regarding a court case. And you probably know bad debt provision as your allowance for receivables. Are you using those allowance for receivables? Are you using debtors and creditors, or are you using receivables and payables?
Supposed to be receivables and payables.
Yeah, it's supposed to be that way. So your bad debt provision there is what you would have called allowance for receivables. Okay? The estimates of the responsibility of directors and result from uncertainties. They are subject by nature, and the estimates may have been made by directors who are likely to be at least partially biased. Some estimates are regularly made by the provision depreciation, or to examine the method formerly used to ensure it remains appropriate. So like once you set depreciation policy, we're going to have motor vehicles depreciated at 15% reducing balance. That should be 15% reducing balance throughout the time, no matter how many motor vehicles you actually get. If you say I'm going to depreciate buildings over a useful economic life of 50 years, you should be able to just go and do your 50 years and you should be able to work out your depreciation. And it should be that figure inside there. So the depreciation will be like, you should be able to see any differences or misstatements showing up there fast enough if they're not keeping in with their policies for depreciation. Audit procedure: the auditor to design and perform further audit procedures to obtain sufficient and appropriate audit evidence and to identify the accounting estimates are reasonable in circumstances and appropriately disclosed. In order for the auditor to design the nature, timing and extent of further audit procedures, he or she needs to understand the procedures and methods used by management in making the accounting estimate. To review the text and process used by management, they must evaluate the data and assumptions upon which the estimate is based, specifically reasonability and consistency. So like, you know, if you're making a bad debt provision, like you're not jumping from like a 5% provision this year to a 10% provision next year to a 20% provision the year after. It should be consistent. I mean, maybe go 4%, 5%, 6%, but it would be like a consistent provision. Testing calculation involved in the estimate, that's just recalculating out what they've already done. Compare the estimates with prior periods and consider the management's approval procedures. Auditors shall obtain evidence so that they are assured the amount is reasonable and properly disclosed in accordance with law and GAAP. The most common audit procedures for estimates are review and test the process used by management to develop the estimate, use an independent expert to make an estimate for comparison with the company's figures, review prior years for examples of the estimate, then compare it to what actually happened, and review subsequent events for events that help to confirm the accuracy of the estimate. And that's a good 4, do you know what I mean, points there, the most common audit procedures for an estimate. If it did come up, the estimates one. I don't have an estimates one tonight, but there is an estimates one inside the pack, the questions. So an evaluation of the results of audit procedures, the auditor must assess the following: the reasonableness of the assessment of the estimate, consistency with other evidence, any significant difference between director's estimates and audit evidence, and the impact of any differences individually and cumulatively. So they could be hard, do you know what I mean, to do. Do you know what I mean? Depreciation should be alright, amortization and goodwill may be a hard one to see, but if you've got a policy in place, that policy is being stuck to by that company. So that's your review of audit estimates. And just one more, I'm just going to go through related parties. ISA 550, which is on page 57, which is not too bad. Like, and the more we get into exam questions, I mean, we've only got a couple of more things to do in the theory, and it'll be all exam questions from there on. Like, we've got 3 or 4 classes left after tonight. Tonight is the 18th, so we have the 4th, the 18th, the 8th. Yeah, we have 4 more classes in auditing after tonight. So I'd say after next I know I'll have nearly all the theory stuff gone through, and I'm doing for the 3 nights after that all exam questions. Okay, then ISA 550 related parties. So central to a number of government investigations in various countries have been companies trading with organisations or individuals other than at arm's length. Such transactions are made possible by degree of control or influence exercised by directors or both parties to the transactions. So read financial statements normally assume that transactions recorded in the account are made between independent parties unless told otherwise. Where a company does business with related parties without disclosing the details, these assumptions would not be valid. So you have to, like, if you have related parties, you actually have to put them on your notes to the accounts that there are related party transactions involved. So the auditor should perform audit procedures designed to obtain sufficient appropriate audit evidence. So that's your line you're going to remember. Sufficient appropriate audit evidence regarding the identification and disclosure by management of related parties and the effects of related party transactions that are material to the financial statements. The audit knowledge of the client must be sufficient to identify related party transactions for the following reasons. The financial reporting framework may require disclosure in the financial statements to certain related party transactions, such as those associated by ISA 24. The existence of related parties or related party transactions may affect the financial statements. For example, tax liability and expense may be affected by the tax laws in various jurisdictions, which require special consideration when related parties exist. The source of audit evidence affects the auditor's assessment of its reliability. A greater degree of reliance may be placed on audit evidence that is obtained from or created by other unrelated third parties. A related party transaction may be motivated by consideration other than ordinary business considerations, for example, profit sharing or even fraud. Management is responsible for the identification of related party transactions. Such transactions should be properly approved as they are frequently not at arm's length, and management is also responsible for disclosure of related party transactions. And from small companies' point of view, I was saying before that the director is renting the building that the business is going on to the company. Okay, so that would have to be reported inside in your notes, the accounts, or if the company was kind of in financial difficulty and the director had given a personal guarantee to the bank over the loan, then that would have to go into related party transactions as well. So that's just from a small point of view. What I'm going to do is actually print off some of the old accounts off the CRO website, and you can actually see where they've put in about related party transactions inside in the notes. Okay, IAS 24, related party disclosures. IAS 24 requires disclosure of material related party transaction. A related party transaction is a transfer of assets or liabilities or performance of services to or for a related party, irrespective of whether a price is charged. In order to determine whether one of these transactions has taken place, a related party relationship must be identified. So deemed related parties. They are simply accepted as having a close relationship with the reporting company and include the following: the reporting entity's ultimate parent undertakings, its own subsidiaries and fellow subsidiaries, its associates and joint ventures, the investor or venturer in respect of which the reporting entity and the directors of its ultimate and intermediate parent undertakings, and pension funds for the benefit of employees. Okay, so these are deemed related parties. Presumed related parties. These are presumed to be related parties unless the contrary can be demonstrated. The key management of the reporting entity and the key management of its parent undertaking. A person owing or able to exercise control over 20% or more of the voting rights of the reporting entity, whether directly or via nominees. Each person acting in concert with such in a way to be able to exercise control or influence over the reporting entity. An entity managing or managed by the reporting entity under a management contract. Okay, so these are presumed related parties. Then in addition, members of the close family of any related party are also presumed to have a related party relationship within the reporting entity. So all the problems. The key risk associated with related party disclosures, completeness of information and substantive procedures should therefore be directed towards the issue. So ISA related parties suggest the following work. So this is what we're looking at, okay? Suggest the following work. So review of the minutes of the meeting of the shareholders and directors and other statutory records such as the register of directors' interests. Review of accounting records for large or unusual transactions or balance, particularly in respect of transactions recognised at or near the end of the financial period. Review information of loans receivable and payable and confirmations from banks. Review investment transactions, again to establish any related party relationships. Inquire of management and director as to whether transactions have taken place with related parties. Review prior year working papers from names of known related parties. Inquiry to names of all pension or other trusts established for the benefit of employees. Okay, because you could have directors who are the employees inside there as well, which you probably will have. Inquiries to collection of directors and officers with other entities. Review the register of interests and shares to determine the name of key shareholders. Inquiry of other auditors currently involved in the audit or previous auditors. Review of the company's tax returns and review of invoices and correspondence from lawyers, because they will probably show you who the transactions were done with the lawyers. They have all the details inside there. So that's probably the important part there, those bullet points down along there, the suggested work for the related parties. I know it's a lot of reading. But when we go to the questions now, hopefully they'll get a little bit better. Okay, so I'm going to leave it with that for the theory part of it, and just take our break and we'll come back and just do all exam questions after that.